This is the Bishop Cross Border Investment Services podcast. I'm Lee Scully. I'm an associate investment advisor. This is Stephen Bishop. He's our lead advisor, our founding member. We're going to discuss 529 plans, which are educational savings plans domiciled in the U.S. Similar to what we have here in Canada, RRSPs, slightly different nuances in how they work, but it's a similar idea where they're meant for education savings. I know, Stephen, you've seen quite a few in your experience. I've seen quite a few. There can be complications, especially from a taxation standpoint, depending on where the beneficiaries and trustees reside. I'll let you tell a story or two, and I know you have a lot of thoughts about that.
Yeah, they're one of those things that are problematic. In most cases, they're not. It's not significant. It's not like dealing with IRAs or trusts or things like that. But we come across them every once in a while, and someone's moved here from the United States, or a grandparent has moved here from the United States and has a 529 for, whether it's, parent for their children or the grandparent for the grandchildren or whatever, right? But what happens is that when residency changes, these plans that are domiciled in the States, the grandparent, let's say the grandparent, the trustee of this plan for the grandchild, is now a Canadian resident, and the United States doesn't recognize, or Revenue Canada, I should say, not the United States, sorry. Revenue Canada doesn't recognize the income that these 529 plans generate as not taxable.
Right.
So whether it's the parent that has the plan for for the children, or the grandparent that has the plan for the grandchildren, it changing their residency now creates a taxable event for them, because the monies in these 529 plans, even though they're intended for these children for educational purposes, no longer receive the tax benefits or the non-taxable benefits that they received in the States.
So it effectively becomes a taxable account.
It becomes a taxable account to the trustee,
right,
the grandparent or the parent, okay? So I've seen a few of these that are larger, and unfortunately, the people weren't aware of this, that they had to start claiming the tax on these plans personally. So it's one of those things that when you're moving to Canada, changing your residency with your IRAs and so on, or if your parents or the grandparents of the children have moved, they may not even know that this is going on. I had one situation where the people had been here for over a decade with a quite large 529 plan that they hadn't been claiming the income on. And when I was talking to them, I said, well, this is now income to you since you've been here as a Canadian resident, and you need to get some tax advice on this, because it was going to create a pretty significant adjustment to their taxable income, and they didn't have a clue. I've had other ones. It's sometimes it's grandparents that move, and they've got the 529s for grandchildren, and just through conversations with the parents, let's say, they say, oh, well, my mother has a 529 for the kids, and so on and so forth, and she lives in Ontario, and does she know she's supposed to be claiming the income on this 529 now that she's a resident? I don't know. and and of course she didn't know, and and so on. So it's one of those things that people need to be aware of. They're not easy to handle either, because you can keep them. So let's just say there's a 529 in place, and they want to keep it, okay, for the children for educational purposes. Well, if the parent wants to pay the tax on what it makes until the kids go to school, they can keep it. There's nothing that says that they can't keep it.
As long as their tax is compliant and they're
aware
of the obligation.
Yeah, at some point, the Canada Revenue Agency and the Internal Revenue Service, everything gets caught up at some point. So they can keep it. Mm-hmm. There's nothing that says they can't have it. They just have to understand what goes along with it. So if they keep it and they keep themselves as the trustee, they have to claim the income on it.
Right.
Okay? They have an option, if they wish, where they don't have to claim the income, and that is they can appoint a family member, let's say, that still resides in the United States as the trustee. And then it will circumvent the need for them to claim the income on it, because it stays compliant with the tax rules.
It retains its tax advantage.
It retains it. The issue with that is that the change of that trustee to let's just say a brother or sister of that adult person, let's say it's the mother or father of the children, so they've got a brother or family member in the States that they can assign as the trustee for that 529 plan. So they can do that, and then it becomes compliant. But what happens is when they do that, they relinquish the control.
Right.
So now it's somebody else that has control over all of this money that's in this 529 plan for these children. And then that brings along with it a whole bunch of other issues, because you can make a list. You've basically given up control of the money. I would say probably in most cases it's not an issue, but there could be something that could come up with with legal things or divorces or who knows what. I don't even want to go there, but you've given it up, okay? And death, the person you've appointed as a trustee dies. What does their will say about, is their will compliant with who's going to be the next trustee of this 529?
So it's a trade-off. Like, you retain the tax advantage, but then there are also some cons to doing that. Lack of control, some estate planning complexity.
There could be all kinds of things, and so a person needs to address those. Some of the things are way beyond what we can advise on.
Right.
It's family issues, it's legal issues, and
tax issues.
But the 529s do and or can create issues when someone moves there. Typically, if the 529s aren't big, the parent will make a decision to liquidate them and just do something else with the money. They'll, let's just say they liquidate the 529 and then in Canada we have our RRSP accounts, and if the kids are small enough, they'll contribute to our RRSPs, or they just take the money and do something else for the kids with it. But those are the only options. They either relinquish the control and sign it over to somebody else that's still in the States, or they cash it out and do something else with the money. And the sooner they figure that out, the better.
Right.
You don't want it 10 years. You don't want to have a large one, and then 10 years later find out that you've been responsible for all the income that's generated, and you have to pay tax on it personally, not the kids.
That's the worst case
scenario. You have
scenario.
to pay the tax on it.
Yeah, that's the worst case scenario. So effectively, there are three options: keep it intact, but be aware of the tax reporting obligations; relinquish control to a U.S. resident trustee; or cash it out. It's always case by case. Everyone needs their own
Case by
advice.
case.
This is not advice. This is a conversation.
It's a conversation.
Everyone should have their own unique advice. We can talk about it with people. We can help them get the right information. We can always publish podcasts.
It's tax. It really does fall under tax advice,
Mostly, yes.
right, or legal advice.
Yep.
Because it's an issue that some people will encounter, and if they've got questions on it, they can do what?
They can reach out.
They can reach out. They can click the contact us button. And,
Send us an email. Give us a phone call.
yeah,
We can talk about it.
We can talk about it. Yeah.
Yeah. Thanks, Stephen.
You're welcome.